Good morning, welcome to Ainsley News. It's Monday, the 21st of December, inching closer to Christmas Day. Hope everyone's ready for a well-earned break. Today we're talking Dr. Copper signals gold rally. There are a number of factors aligning on why now might be a good re-entry point for gold. The 4-month correction since gold reached all-time highs in August has, as it did in the big liquidity squeeze in March, found support at the 50-week moving average, or WMA, maintaining gold's bull run since it passed through the 50 WMA at the beginning of 2019, as can be seen in this next chart. Look at that, neatly following that line, but pretty much staying above that from 2019 to 2020. Wing Capital, the authors of the previously shown chart, see this and two other points as constructive for the gold price. They too look at the relationship with copper, or Dr. Copper, as many economists refer to it as a historically important indicator. Copper has surged to its highest price since 2014 on reflation expectations, while gold has declined on the same. Copper versus gold price here shown in this chart. This move has seen a breakthrough of the 50 WMA for the copper to gold ratio, just as it did in late 2009 during the GFC, as you can see in this next chart as well. From their report, a more crucial observation is that the multi-year bull market in gold started in late 2008, right before the recovery rally in gold and copper ratio commenced, and only ended in 2011, after gold more than doubled its price. Also, notice the 50 WMA continued to serve as a launchpad to higher highs over the course of the bull run. In short, the historical analysis suggests that the bull market in gold does not necessarily end when a cyclical recovery is underway, and that the recent pullback is no more than a healthy retracement towards its long-term moving average. Their second indicator is one we've written to frequently, and that of course is all the debt and its drag on GDP. Further supporting a breakout year ahead in gold is in fact the federal deficit versus GDP ratio is set to balloon above the 2008 GFC highs of 10% and even above the World War II record highs of 30%. This per Axios. The federal budget deficit will reach $3.3 trillion in the fiscal year ending this month, more than triple the 2019 shortfall, the Nonpartisan Congressional Budget Office, or CBO, projected on Wednesday. Why it matters? That would be a 16% of GDP, the largest amount since the end of World War II in 1945. The national debt is projected to exceed 100% of GDP in 2021 and rise to 107% in 2023, the highest in the nation's history, the CBO notes. This is a chart here, the federal deficit as percentage of GDP versus the spot gold price. Not a bad graph to check out here. This time around, the unprecedented amount of fiscal measures enacted to combat the economic fallout from the coronavirus pandemic has already exceeded that from the last crisis, with no signs of slowing down. With the deficit to GDP ratio expected to continue expanding for years to come, we anticipate gold to embark on a multi-year breakout similar to that from 2010. On that note, we reiterate our long-term price target of $3,000, which we can expect to be reached by 2022. Coincidentally, and to digress momentarily to address the Bitcoin is replacing gold rubbish, Goldman Sachs came out late last week to maintain they see no evidence that Bitcoin's rally is cannibalizing gold's market and believe that the two can coexist, in part using copper again as an indicator. This next chart we're going to show shows the tight correlation between copper and Bitcoin. People might not have seen that chart before, but fascinating. And this from Goldman. In our view, Bitcoin is the retail reflation trade, while gold is a defensive asset with long-term real capital preservation. In addition, gold's recent sell-off was more closely aligned to a vaccine-driven risk-on rotation rather than an abandonment of gold as a hedge against debasement. There's another chart here showing gold's recent underperformance has been driven by risk-on rotation. Such aggressive rotation historically doesn't last too long, as investors quickly rebalance their portfolios. Therefore, in early 2021, we expect gold ETFs to rebuild. Given the rising inflation expectations, weakening dollar and lofty valuations in some risky assets, demand for safe haven inflation hedges should remain supported next year, continuing to push gold towards our $2,300 per ounce target. Wow, big stuff there with copper versus gold, and interestingly, copper versus Bitcoin, if you haven't seen that chart before. Remember, AinsleyBullion.com.au for all things physical, gold, silver, and platinum. AinsleyWealth.com.au for all things cryptocurrency. If you're interested in Bitcoin, Ethereum, they're the places to jump in there. And GoldSilverStandard.com if you're interested in an easier, more efficient way to purchase gold and silver and know that it's back to real gold and silver and securely stored at Reserve Vault. Check out GoldSilverStandard.com. We'll catch you tomorrow for more news.